We are live on YouTube, first time home buyer webinar. I'm here with in-house mortgage broker Tom Miocevich.
Hi everyone.
Let's jump on. Here we go. So on today's agenda, we'll go through what you can afford, interest rates, the buying process. We'll go through a couple purchase examples, talk about if now is a good time to buy. If you do have any other questions, throw them down in the comment section below and we'll get to them after this has been released. So what can you afford?
Typically, whenever I'm speaking to anybody about how much they can afford with their mortgage, we use like rule of thumb. So, typically if you're putting down 20% or more, I would usually say or ask them, what is your income or what's your combined income if you're buying with a partner or spouse? And what I would normally do is take that income and multiply that by 4. So if you're putting 20% down or more, and let's say you're making a combined income of $200,000 per year, and that's gross, that's before tax, then times 4, you're typically going to be affording an $800,000 mortgage. So if you have, let's say, $150,000 or $160,000 to put down, then your purchase price would be in the range of $960,000 with an $800,000 mortgage qualification. And then when it comes to those purchasing with less than 20%, we call those default insured mortgages. The rule of thumb, it decreases to about 3.5% your income. So if you're making an income of $100,000 a year, then again, the mortgage that you would qualify for would be $350,000. And going back to the old example of $200,000, then you're looking at $700,000. And the reason behind that is the amortization period. With a mortgage that's not insured, you can actually have a longer amortization period, being 30 years. And with an insured mortgage being 25 years. If you have debt, let's say you have a car loan or a credit card debt, typically $25,000 of debt equates to $100,000 less mortgage that you can afford. So again, if you had no debt and you were qualifying for a $700,000 mortgage, but you had $25,000 in credit card, then that qualification would be reduced to $600,000.
Can you break down the monthly cost, for example, on per $100,000?
So another rule of thumb would be, how much would a $100,000 or $500,000 mortgage cost me? So what we typically do, so if you're putting down 20% or more, you're looking at roughly $600 per month per every 100,000. So if you borrow $100,000, that's going to cost you $600 a month. If you borrow $500,000, that's going to cost you roughly $3,000 a month. And when you put less than 20%, again, because the amortization is less at 25 years, you're looking at a bit of an increase of about $615 every month per 100,000.
Can you explain amortization?
Amortization is it's a kind of a tricky word because people always hear 5-year term mortgages or variable rate mortgages, but the amortization is the time it will take you to pay off that mortgage fully. So if your interest rate doesn't change for the next 25 or 30 years and you have a payment of, let's say, $3,000 a month, it will take you 25 or 30 years to pay that mortgage completely to zero. So that's what your amortization period. Whereas the term of the mortgage is basically the banks or the lender coming to you and saying, we're going to offer you a rate for the next 5 years at this term. And then after your 5-year term or 3-year term or whatever term you decide to take, once that matures, then you have to renegotiate another term. So you can do another 5-year term. You can go up to as high as 10 years if you wanted. But yeah, that would be the difference between the term of the mortgage and the amortization.
Let's also break down the cash requirements because under $1 million, there's different rules of the minimum you can put down. Can you go through those for us?
For a default insured mortgage, the maximum purchase price is $999,999. So as soon as you put a 1 in front of that purchase price number, you have to put down 20% or more. If you purchase for less than $1 million, then you can put down a minimum of 5% for the first $500,000 that you borrow, and then 10% for any amount above the $500,000. So for example, if you were to purchase for $650,000, the first $500,000 would be at 5%, which is $25,000, and then the next $150,000 would be at 10%, which is $15,000. So that would equate to a $40,000 down payment on a $650,000 mortgage. And again, a default insured mortgage is anywhere from 5% to 19.999%. Anything above 20% is considered a non-insured mortgage. And anything, again, over $1 million, you would be required to put a minimum of 20%. And that can increase with the purchase price value. So if you end up purchasing a property for, let's say, $2 million, $3 million, the bank may require you to put a little bit more. And then when it comes to closing costs, lawyer fees, if you're putting less than 20% down and it's insured, we would ask for you to set aside anywhere from, 1.5% to 3% of the purchase price. So if you're purchasing something for, let's call it $500,000, then you should have set aside an additional $1,000 for closing costs.
And that's due at the end with the lawyer.
Yeah, so a lawyer's going to be asking you for like land transfer tax, lawyer fees. There could be some credits that could be required to pay the seller. Maybe the seller paid for property taxes for the rest of the year, but you bought the property in July. So there could be some credits that you might be required to pay.
Let's talk about deposit and down payment, because these two terms sometimes get thrown around where it might seem like the same thing, but they're actually two totally different things. I'll cover deposit. Tom will get into the down payment, but the deposit demonstrates the commitment of the buyer to the seller to complete the purchase. This also counts towards the down payment amount. So when you have an offer accepted, so you submit an offer on a property, if it's accepted by the seller, then the deposit's due within 24 hours or with the offer. Either one depends on how we structure that offer. It's typically 5% in the Greater Toronto Area, and you're going to want to have those funds readily available when searching for properties, because if you do find that property and you do want to make an offer, you need to have that 5% ready within 24 hours. It's not something that if you have to pull it out of your bank and wait a few days, that 24 hours starts the second the offer's accepted. Can you talk about the down payment, Tom?
Yeah, so just to kind of continue what you're saying, there are some financial institutions, some of these online banking types, that you wouldn't be able to get a bank draft within a 24-hour period. So it's good advice. You definitely need to have, if you are in the process of buying something, or there's a property that you like a lot and you know you're going to be putting an offer on it, you definitely want to have that money available, so that way if your offer is accepted, you can write a check within 24 hours. And when it comes to the deposit and the down payment, so if you were to put, let's say, $100,000, your total down payment is $100,000. But you provided a deposit of $15,000. You still would then at the end pay the $85,000 to your lawyer. So that way the 15 that you already put down plus the 85 equals the 100. But that additional down payment is paid to your lawyer typically about 4 or 5 days before the closing date, when you sign the final transfer documents, mortgage documents with your lawyer. And whenever we do mortgage approvals, banks typically require a history of 90 days. And that's because of the Canadian anti-money laundering legislation. So they want to make sure that you're not all of a sudden depositing, $50,000, $100,000. Like, they want to make sure they know where this money's coming from. It's not coming from any fraudulent activity. So they want to see a history of 90 days in a bank account. And again, during this pre-approval process, I usually advise my clients not to transfer money around between accounts, because we're going to need a paper trail for every one of those accounts. So one good piece of advice is, if you are searching for a property, just keep all your money for a down payment where it is, and not to transfer it around, because it will make it a little bit more difficult. Down payments, you're allowed to get a gift from immediate family member, so mother, a father, brother, sister, grandparents. And if they've already provided you with this gift, and we look at a 90-day history and we see there's a $50,000 deposit, and you say, hey, oh, Tom, this came from my parents, then every lender has a template, a gift letter template, and it's a fill in the blank. Like, I am providing Mike with a $50,000 gift to purchase ABC property. So not really much involved with that. Sometimes some lenders do require a bank statement showing that money coming out of your parents' account, just to make sure that they also had it and it's coming from that source. So it definitely is available. And then RSPs, you can take up to $35,000 from your RSP as long as it's been in your RSP for the last 90 days. Another misconception is when people are putting a deposit and they're expecting to use their RSP money for that deposit. So what Mike talked about, that 5% in the Greater Toronto area, because you need to be in a written agreement with a property within a year in order to withdraw that money from the RSP. So if you are willing to put an offer on a property and you take the money out of your RSP, and for whatever reason that purchase agreement doesn't go through, you've now withdrawn money from your RSP and you're not in a actual purchase agreement, which could have tax implications down the road. So definitely do not touch your RSP until you have a firm sale agreement. And another thing too that you want to avoid with deposits is asking your best friend, asking for money for that, because they're not an immediate family member, it makes it a little bit more difficult to say that it's a gift. You can use money from your line of credit or credit card. Let's say you have a $20,000 line of credit and you need a $15,000 deposit. You can take it from the line of credit, and one of the conditions before the mortgage is advanced is that line of credit is paid back, which you can use your RSP to pay that back. And the RSP doesn't necessarily have to go towards the down payment of the property. As long as you're a first-time buyer and you're in a written purchase agreement, you can take that money out for anything, furnishings, land transfer tax, etc. But you have to be in a firm sale agreement.
So the elephant in the room that we keep hearing about all year, basically since March 2022, is interest rates.
Right.
Let's jump into the various factors of interest rates and your thoughts on them.
Yeah. So the last interest rate announcement from the Bank of Canada was on October 25th. And probably up a week or 2 weeks before, the word on the street was they were not going to raise interest rates. We've had some weaker job numbers. Inflation numbers have come down a bit. The overnight lending rate is the interest rate set by the Bank of Canada raises or reduces interest rates that fixed rates come down. Because fixed rates are set based on bond yields. But the bond market is influenced based on news. So if the Bank of Canada has news and they come out saying, I think we've topped out on raising the overnight lending rate, which reflects the variable rates, then that news translates to the bond market, which then you would see bond yields come down lower and fixed rates coming down lower. And why do bond yields and fixed rates have anything to do with one another? Well, whenever a bank takes out a mortgage, they securitize that mortgage with a bond. So if a bond is, if it costs less for them to purchase a bond, then that means the interest rate that you're getting on a fixed rate would be less. So what's going to happen next?
This is the typical process of buying, and we're going to keep things pretty basic. Typical process, we figure out a timeline. You connect with a mortgage broker for your budget, pre-approval. We have our strategy call. We go search and look at viewings, make an offer, and close. We're going to go through each one by one to really break that down. So we always start with timeline. And the biggest question I always ask to any of my clients is, when do you want the keys in hand? Not necessarily when do you want to start your search? Because if you were looking to get your keys in hand, or if you're looking to purchase in, for example, March, does that mean you want to move in March, or does that mean you want to start the process in March? Two totally different things. Typically, it's a 4 to 6 month process, and we try to work backwards. If you are looking to purchase in March or April, we're within that 4 to 6 months basically now. And it does take a little bit of time to get the pre-approval, start the property search, find a property that you like, and make an offer. And then depending on the property type, there are some properties that are more competitive than others right now. And then satisfy the conditions, 60-day on average closing to your keys in hand. And typically that process anywhere between 4 to 6 months on average. Of course, it could happen sooner, it could happen later. There's never a rush on that. But in general, we always say work backwards from the time you're looking to have the keys in hand. If you're in a lease, for example, and your lease is up March 31st and you're looking for something after that, 4 to 6 months from the end of that lease term is a good place to start. Let's talk about pre-approval, Tom.
So pre-approvals, generally they last for 120 days. And the reason for that is we can only hold interest rates for 120 days. So a bank lender is not going to offer a pre-approval for longer than they can hold an interest rate, because they don't know what the interest rates will be 30 days, 60 days from now. So from the day that someone calls and from the day that we submit an application, you can look at having a pre-approval for 120 days. And we're already, November? So what's that, December, January, February? So we're already now mid-March, which is crazy to think that you can be pre-approved for and have an interest rate held for that long. And the beauty about holding an interest rate is that if interest rates come down from today, we can keep on rebooking that rate. So if today you're getting 6%, and then let's say January they're at 5.5, we can rebook it at 5.5, and then extend that 120 days from January. And if they come down, if you still haven't found a property and it's now March and now they're down to 4%, then we can rebook it again for 120 days, just as long as nothing's changed in terms of employment, credit history, down payment, etc. Another thing people always ask me is like, what does this stress test mean? So basically, a stress test is the actual rate that you're getting. So if you're going to get an interest rate today of 6%, and let's say the mortgage is $3,000 based on 6%. The stress test is you have to qualify as if the interest rate was your contract rate plus 2%. So you'd have to show that you can qualify a mortgage at 8%, even though you're only getting 6%. And then again, whenever I get a phone call, I always hear, "Hey Tom, I went online and this mortgage calculator tells me I qualify for this." Someone might have made $150,000 this year, but that was based on bonuses and commission. But the last 2 years, maybe they only made $80,000 in bonus and commission. So what they'll typically do is they'll go online and put in their income of year to date or what they've made last, in 2023 or 2022, and that could definitely skew the approval process. They're great in terms of telling you how much your mortgage payments will be and kind of giving you a rough idea. But I'd say over 50% of the time when someone comes to me after saying, "Well, I went online to see how much I qualify for," it's usually a lot less, because there's a lot of things that the online calculators aren't asking you for that I would. And then another big question I get today is fixed versus variable. They hear the news and they're like, interest rates, they kept on hearing about is interest rates. If you're comfortable with the payment and you're comfortable with the payment for the next 3 to 5 years on a fixed rate, to each his own. Fixed rate could be perfect for you. And then another question, I usually ask, how much do you want to spend per month? Not necessarily how much you qualify for, because someone might be able to qualify for a $4,000, $5,000 mortgage, but they might not necessarily want to pay for $5,000 a month, especially once you start adding all the extra costs. Like if you're buying a condo, there could be condo fees, property taxes, home insurance, and utilities, internet, all these different things that they necessarily didn't factor in. So we usually work backwards and say, well, if you want to spend $3,000 a month, then you're looking at a $400,000 mortgage at about $2,500. Plus you want to buy a condo, so that's another $500 a month. And then you've got your taxes, which is another $200 a month. So now they're already at $3,200 without their internet, without their utilities. Maybe even though I can afford that $800,000 mortgage, but I don't want to spend that money that makes me, get an $800,000 mortgage.
The next part about that, we do the strategy call, and this is one-on-one with me, and this is where we really break down different aspects of exactly what you're looking for, so I can get the best idea on how to help. And things we'll talk about is search criteria, budget, closing costs, what's actually happening in the market. And our market in Toronto, for example, changes on a week-to-week basis. It's really important to go through that as close as possible to when starting the buying process. We talk about the offer process, different conditions, the closing steps. There is representation paperwork that is involved and super important to go through together. And then we set times for viewings and get out there and start taking a look at properties and trying to find the perfect match for what you're looking for. With that, making an offer, we did mention that 5% deposit, which is due either with the offer or within 24 hours of an accepted offer. They're going to want to connect with your lawyer, mortgage broker, let them know, hey, we have an accepted offer. And then we start working on conditions. If, for example, status certificate, which looks at the health of a condo building, home inspection, where we take a time to bring a home inspector into the property to take a look at everything. And then financing, which is where you would also connect with your mortgage broker and go through the financing and whether or not you qualify for that purchase. Then we would have some buyer revisits. So we can go see the property a couple times before actual closing if you want to take, for example, measurements or just see it again. It's an exciting time. If you purchase a property, typically you want to go back and take a look at it and then prepare for closing. And there's various steps to make sure that the utilities are set up and internet's ordered and all that stuff, and even moving trucks and that kind of thing. So a bunch of different processes here in the process to close. And then the last week before closing, typically within the week, you'll meet with your lawyer. Along that way, you'll also be discussing with your mortgage broker different aspects of making sure everything's ready to close. There are closing costs, which you want to keep in mind, the remaining down payment, any adjustments. The lawyers will give you a breakdown of all of that. And then one thing I always recommend, keys typically don't happen until the afternoon of closing day. So it might even happen as late as like 5 p.m. So if you're expecting to get the keys at 9 a.m. on closing day with the moving truck, I would generally recommend waiting till the day after getting the keys for your full move, just because if there's any delay on closing or if it doesn't close till the last second of the day, you don't want to be sitting there with the moving truck, because until you get those keys, you don't actually own the property. And then a big congratulations, which is pretty exciting when you buy your first home, any home really. Those are the steps. And then let's go through what an example of a purchase actually looks like, and we'll let Tom take that away.
So I brought this up, the purchase price of $650,000 earlier. And then in this example, we're looking at a $400 a month condo fee and taxes of $2,400 a year, so $200 a month. So if you're looking at putting less than 20%, your minimum down payment would be $40,000. First $500,000 is at 5% and the remaining at 10%. The CMHC insurance, so CMHC, the Canadian Mortgage Housing Corporation, is an affiliated government program that allows individuals with less than 20% down to purchase property. They do charge a one-time premium, which gets added to the mortgage. So if you were to purchase a property for $650,000 and you put down $40,000, you would expect your mortgage to be $610,000. But once you add the CMHC default insurance premium, your mortgage then increases to $634,000, and that's what your mortgage payments will be based on. So an example right now, if we were to look at a 5.89% interest rate, a 25-year amortization, again, that's the maximum for an insured mortgage, then you're looking at a monthly cost of roughly $4,020 per month. And then once you add your $200 a month for taxes, the condo fees, you're roughly now about $600 additional to that. So now, you're looking to $4,000, and then other costs that you want to keep in mind: utilities, insurance. These are some additional costs. I didn't include internet. This is kind of where we talk about budgeting and seeing where you're comfortable at. Even though you can afford $6,000 a month, you might be that type of person that likes to travel and nice to go out to restaurants. So we definitely need to put things in perspective. And the type of income that would be required for this scenario in today's rate environment, you're looking at about $165,000 per year. Again, to go through the down payment kind of quickly, was $40,000. Again, for the first $500, you can put up to 5%, which is 5% of 500 is 25,000, and then the remaining 150. So 500 plus 150 gives us that 650 purchase price. So that 150,000 over that 500 is at 10%, which is 15,000. So when you add the two together, that's how we come up with a minimum down payment of $40,000. Now, if you put 20% down or more, then on a 650,000 purchase price, so 650 times 20% gives you 130,000. Because you're putting down 20%, there is no default insurance premium. If you take 650,000 minus the 130, you get 520,000. Now we're not having to add anything on top of that, like we did with the insurance premium. So your mortgage is 520,000, and based on 520,000, putting down 20%, you can go up to now 30 years to pay off this mortgage. And you will be paying a bit of a premium for taking a 30-year term, but at 5.99%, your payment would be roughly $3,000 per month on a $500,000 mortgage. And then again, you've got your taxes, condo fees, utilities. So you want to budget around $4,000 a month for $650 with 20% down. And the income required, I have here a range of 115 to 130,000, and that's because whenever you're putting down 20% or more, since you don't have to go through the default insurance program, some lenders have leniency in terms of your debt service. Like, how much debt can I service based on my income?
So the question we get asked all the time is now a good time to buy? And the honest answer is it really depends. It depends on everybody's current situation. That's number one. There are a few things that I did want to bring up, and first of all is the media. And what I can bring up is actual data. A lot of the articles right now are saying that we are in a buyer's market. And while that is true for some property types in some areas, that is not exactly true for every property type in every area. When we talk about a buyer's market, the basis of this is months of inventory. This is a term that gets thrown around all the time by realtors and might not be something that you're familiar with. Essentially, you take the active listings that are available, you divide them by the monthly sales, the current month, and you'll get a month's of inventory. When we are between 1 to 3 months of inventory, that is a seller's market. That means that every property on the market would sell within 1 to 3 months. Balanced market territory, 4 to 5 months of inventory, and buyer's market is over 6 months of inventory. Now, I just want to point the attention here to where things were at the end of 2021 across the Greater Toronto Area. On average, we were at 0.8 months of inventory, which is not even seller's territory. That is ultra seller's territory. As things crept up throughout 2022, we hit in and around that 3 months of inventory range. And then at the start of this year, when prices did move compared to where they were at the end of last year, we were back down into that 1.5, 2 months of inventory. Right now, we're sitting as a Greater Toronto Area as a whole, all property types combined, around just over 4 months of inventory, which is balanced territory as a whole. That being said, if we look at some of these major sections in the Greater Toronto Area, and this is from Urbanation, there are some property types, most notably condos, that are in buyer's market or right about getting to a buyer's market territory. For freehold property, so if you're looking for a semi-detached, a row house or a townhouse or even detached, it really depends on the property type and area that you're looking in. If we look at Toronto East, the east part of Toronto, there's 2 months of inventory. It's very much still in a seller's market for the properties that come to market. But if you're looking for a central Toronto house, detached, there's about 5 months of inventory. So every property type in every different location is performing differently. And that's why when we do set up our strategy call, we discuss before the strategy call kind of the areas and property types that you're looking for. That's where those calls will really dive into what is exactly happening in that exact market. And the other thing I will mention, when we are in a 1 to 2 months of inventory, that's when you see more and more offer dates. When we're in a 4 to 5 to 6 months of inventory, you see less offer dates. So now that we're in 4 months of inventory territory, for example, especially for condos, not seeing as many offer dates right now and more properties are on the market. But if you're looking for a detached home in the Toronto East market, you may run into offer dates still going on even in today's market. So case by case, Toronto West as well, for example, you might be running into those offer date scenarios, even though the general consensus is that everything is in a buyer's territory. It is property specific and market specific. It's important to look at housing long term. What is your goal for this property? How long do you plan to stay there? And can you grow with the property over time? And can you, instead of looking at it from what is the house worth on a day-to-day basis, think long term, think 5-10 years down the road, what that property could do in a city like Toronto, Greater Toronto Area over time. And having that long-term outlook is super important, which brings us to our next point. There is no best time to buy. It's always about your personal goals when you are ready. And then the cliche saying, time in the market, not timing the market. It's true. This is what the data tells us, is that it's the time in the market that you take to enjoy your property. And I think that kind of gets lost sometimes, where a home is a home, not just a property. Send a comment down below or book a call in my calendar link, first link in the description down below. Thanks for tuning in.
Thank you.